Hey everybody, John Duncan. Just wanted to come to you quickly. I put together some free training for you here, and I'm going to title it Why You Are Not as Rich as You Could or Should Be. And I hope you enjoy. So, with that, I'm going to switch over to a different screen and enjoy this free training. Thank you. Okay, let's get this thing started. Bottom line is, as we all know, there's what's called traditional planning. You go out, you get a job, you do the best you can, and the thing is, it's all focused on earning higher and higher levels of income. And here's how I want you to think of that. Essentially, if you're striving and doing the best you can, hopefully your income is rising higher and higher. And the problem with traditional planning approach is that at the same time, you've got obstacles going on. And what are some of the obstacles? Taxes, lifestyle costs. You start making better money and your lifestyle goes up. You need a bigger house, bigger everything. That's fine. But it's an obstacle because it's going right along right with you, and it's making getting wealthy harder and harder. So taxes, lifestyle, even overhead. If you own a business, it's going up higher and higher because you're driving for more and more growth. And bottom line is, most people are on this traditional plan permanently, regardless of how high their income is. They never break free from that. And what I'm going to talk to you now about is a few things that once you know them, you'll never think of money and growing money the same way again. And this, again, is for people that have done pretty well. You're making 500 million or more a year. You've built up some assets. And in this system, this traditional planning system, if you've got $1 million, 5 million, 10, wait till you see what I'm going to show you now, because it is the way billionaires and corporations look at money. So before I get there, I want to go back to just some key things that you need to understand. 1971, August 15th, 1971, Richard Nixon, President Richard Nixon, better known for Watergate, excuse me, he took America, he broke what was called the Bretton Woods Act, which was established in 1944. He broke that. And what does that mean to you and me? That had us on a partial gold standard. And so part of the money supply was tied to the money standard or gold standard. And what that meant to the country is they couldn't just make money appear. And coming to the end of the at the end of the 60s, early 70s, America wanted to grow. And to grow, they needed cash, capital. And by breaking the gold standard, it gave the country basically unlimited cash to go. And so you could argue it was a great move, because in the 48 years since then, there's been more progress in technology and, buildings, you name it. It's been crazy because of breaking the gold standard. But what does it mean to consumers like you and me? Well, what happened is they basically made creation of money and what the money was supplied to, it turned it into monopoly money. What do I mean? Well, at this point in time, they're adding in 2019 here 5.9 billion dollars a day times 7 days a week times 365. That's in 2019, is being added to the money supply. And how is it getting there? A lot of people are thinking it's like printing presses and things like that. No, 97% of all dollars are coming via banking, specifically loans. So, what does that mean? Well, since 1971, the money supply itself has increased just over 32 times. The stock market is up just under 32 times. So it's increased 32-fold. Stock market is at the same rate. So what does that mean? Basically, the market is being driven by this monopoly money. And again, this is just a quick overview training. So I'm not going to go into deep detail. But point being, the value of the dollar has dropped in the same time period since 1971. 84% drop in the purchasing power. So I call it the double kick in the wallet, because we live, going back to here, with a progressive tax system. And all that means is the more you make, the more they take. Well, $1 million today in income would have, based on the purchasing power, really been only 160,000, which would have been phenomenal back in 1971. Well, the taxes on 160 are a heck of a lot different than they are on $1 million. So not only do you pay higher on the million, but because the value of the dollar has dropped, it looks like you're making more money, but in fact, you're actually just paying a lot more taxes. So I call this the double kick in the wallet. And as they continue to add more and more to the money supply, this continues to cost producers more and more and more. Because it looks like you're making more and more money, but in reality, it's that the purchasing power is going down. Now, you might be making more. I'm not saying you're not making more, like dollar number wise, and you might even be doing better, which would be more. What I'm saying is if you were making the exact same cross comparison, because of the purchase power drop, it is causing more and more taxation. Now, why is this all important? Why is this important to you? Well, this is the whole reason when you watch the news and you see housing prices way up, the cost of cars through the roof, education through the roof. What do all three of these have in common? Financing. In other words, loans are fueling all of these and many more things, including businesses and so forth. Well, the common person, what is the theme of today? If you look at like the Dave Ramseys and all that, the Susie Ormans, is don't carry any debt. No debt. No debt. No debt. When the economy is running 100% on debt. That is the economy today. I mean, let me ask you a question. How many people, like when homes get sold, if you went to a brand new neighborhood today and they'd sold 30 homes, how many people do you think paid cash for those homes? Almost none. And the ones that did were actually making a mistake. And I'm going to talk about that here in a second, but we are in a debt-based economy. And to me, why this is a super important, and I'm putting it in this training, is this August 15, 1971 is the day that traditional planning died. Before 1971, before August 15th, inflation was very low because money couldn't just be blown out like $5.9 billion a day. It wouldn't even be on the table. It was very stable. And actual savings paid actual decent rates of return. Now go put money in the bank, it pays next to nothing. So what am I saying? Let's go back to the house example. And we're going to start talking about now how you break free from this and actually use it to an advantage. Because here's the thing that a lot of people don't understand. You know, you see all the bad news on the news, and literally all this right here is killing the middle class, And I believe if it continues at the rate it is, we're just going to have and have not. And we're going to be like a lot of other countries already are, where you got this filthy rich and everyone else. And what I'm trying to explain here in this simple, quick training is how you can be one of the haves instead of being one of the have-nots by using the rules of the new game that started in 1971. So now let's move on to breaking the game down to how you put it in your advantage. And I want to just think about first, like a house. You can go, and a lot of times when people start making money, the first thing they think is, pay off my house. I want you to think about it a little bit different. Again, we're on a debt-based monopoly money society right now. So let's look at it. Like, you can say this is a $500,000 property, okay? Say you put 20% down, so you put 100,000 down. 400,000 gets financed. Okay, 400,000 financed. I want to ask you some questions on that. Do you pay any taxes on that? I mean, if that was 400,000 in income, you add it to your other income, you pay taxes on that. And in California, if your income is over $1 million, you have to make 800 to net the 400. But when you take a home loan, that is not taxable. Also, let's say that the interest rate on it's 4%, just to keep it simple. You've got $16,000 in interest. That's now a deduction every year. So, and let's say that house grows to 1.5 million down the road, and you leave it to your heirs. Do they pay any tax on the difference between 1.5 and 500,000? No, they get a stepped up basis, meaning they are able to now assume it at 1.5 and there's no taxes. Again, think back to the traditional world. You go earn $1 million, you pay half of it to the government. This, my friends, is just a very simplistic look at how the rich get richer and richer, because they're not using the tax, they're not out focused strictly on income. And I'm going to show you how to reposition your thinking so that you start playing, you start going with the wave, not against the wave. But in this example right here, some other thoughts on that, because it's real estate. You know, somebody could have a piece of real estate like this one here. They can claim depreciation, you know, the interest deduction. I mean, it just goes on, the number of deductions. But why? Because the government is actually in the business with banks of creating the real employee, which is dollars. And I did some research on this when I started really diving deep on this. And look at this. How many times does $1 change hands per year? Based on the government statistics of inflows and outflows at the bank, 138 times per year it changes hands. And on most of those, if not all of those 138 times it changes hands, it is income to someone or something, a business or a person. And what does the government tax? You got it, income. So even at a 30% tax rate, like 30% tax rate, that $1 would create $41 per year for the government. So this is why they want more and more and more dollars created, because every dollar created goes into the economy and starts, in essence, working for them. Because it's like this, it's like if a landscaper comes to my house, I give him $100. He takes it, goes to the gas station, gets some gas station owner takes it to the grocery store. It's all about velocity of money. Every time it changes hands, it's either income to a business or a person, which is what the government focuses on, is income. You know, you could ask the question, like France many years back said, you know what, we could just eliminate the debt if we tax wealth. We'll just tax wealth. And I actually did the math on it. You could eliminate the federal deficit by taxing the wealth in America just over 15%. So 15% one-time tax, and then a 3% tax per year would pay all of the government's obligations. But why don't they do that? One reason is the same reason France had a problem with it, is the rich people started leaving the country. And the other reason is what attracts loans. It is assets. So things like real estate, things like insurance, things like cars, all these things, and income and savings, all these things are needed to create loans. So the wealth, think of it like this. I'll keep it really simple. Wealth attracts loans. Like you can't go to the bank and get a loan if you have no assets, no income, no nothing. And back to this, the government wants more and more dollars because it changes hands based on their study 138 times a year, which creates income tax. So my point of all this is to use this to your benefit. You have to be more, or think outside the box, more like a billionaire, and use your income and assets as all they are is like your hub. That's the way I like to think of them. As your hub, you attract other people's money, or monopoly money, however you want to look at it, to go buy assets. And here's the math on it. Here's the math. Say you could go secure $10 million based on your income, assets, or business revenue, whatever. And you could do it at 4%. And you could even make it deductible, so half of it out. So you could control it with 2%. So that costs you $200,000 a year to control 10 million. Say that 10 million went into real estate, whatever it went into, but something super stable. And let's say that this asset grew by 6% a year. That would mean that it grew at 600,000. It grew 600,000. Take out your cost. It's 400,000. So what does that mean to you? That's 100% return on an asset that paid 6%. Does that look like more risk or less risk to you? More or less risk? 6%, not chasing 15% and lose it all. 6% investment. This is exactly how banks make money. This is how insurance companies, the stock market itself. It's all about, the word they use is arbitrage. It is using this monopoly money, the post-1971 America money, and using it to acquire assets that are safe. I'm not talking about going and putting money in and doing like a margin account in the stock market. I'm talking about safe, stable assets. Boom, arbitrage, 100% return. And let's just say he or she leaves this in there. So look at the asset now is worth 10.6, and it's in a wealth-based asset, as we talked about over here. There's not even any tax on the growth. It just continues to grow year after year. Again, compare that to income. If he added another 600,000 to his or 400,000 net to his income, he'd have to pay taxes on that. So these, I've broken it down. I didn't learn any of this. The first 20 years, let me say this. I came from middle class, lower middle class, from the Midwest. Got into the financial industry, did really well, but in my first 20 years, even in running a successful financial planning practice, none of this is in any books. They don't lay it out for anyone. And so 20 years I'm in business, and I got super frustrated because I started running up against the wall. I was paying more and more and more in taxes and seeing I wasn't netting near what I wanted to. I wasn't getting wealthy. And this was like 10 years ago. And then I just said, I almost left the industry. I went off the grid for quite some time, studied every book I could find, tracked down every professional I could find, met tons of wealthy clients. And then I started building strategy. And I actually, now, the last 5, 6, 7 years, all I work with is super wealthy clients. And they have verified everything I'm saying is exactly how they have got where they're at. And I've broken it down into 3 pillars to wealth that nobody's talking about. And just so you know, they don't focus on the market, the stock market. They don't focus on what's going on day after day on the political and economic. None of that. It's just 3 separate pillars. It's simply, number 1, tax strategy. No client I ever talked to that's worth over $100 million looks at anything without asking first question, what's the tax angle? Because they understand that every dollar that's lost to taxes, using the law of 72 is an $8 loss over 30 years. So what does that mean? If you take an interest rate like 7% divided by 72 equals basically 10 years. So first 10 years turns into 2, second, and then 30 years out, you're $8. So think about it like this. If a business person overpaid taxes by $1 million through some time, they really cost their net worth over the next 30 years, $8 million. How crazy is that? So tax strategy is number one. Second is leverage. And that's playing Monopoly with the monopoly money, using getting your tax strategy correct so that the tax strategy gives you the dollars, the extra dollars and so forth, which will create more leverage. And then number 3, passive income, I like to call pipelines. So, and it's in this order. 1, 2, 3. Fix the tax strategy first. Get you off of the grid that is, let me back this out, the traditional, where you're just paying more and more in taxes and not getting anywhere, to cutting that down to nuts to nothing, using advanced strategies, not CPA level strategy. We're talking advanced strategy. Creates more, then you create leverage, and you go against the grain of the Susie Ormans and all them. Debt is bad. No, debt is the economy. Debt is the economy. I saw the other day that $59 trillion had been added to the world debt market since 2008. So I'm just saying, you can play. I always like to think of it like this. If you earn $1 and then get taxed at 50% minus 50%, so 50 cents, you end up with 50 cents. Then you've got to pay for lifestyle and hope to have something to save afterwards. Let's say you save 10 cents. And then you take it to a market and hope to God it performs and hope it doesn't crash whenever you need the money. Or the new game is earn $1, create leverage, have passive income streams, have the dollar working, maybe working in multiple places via leverage. And that is the difference. Like, it's so crazy to me, but you know, I remember back in the day before I learned all this, I was linear in thought, thinking, okay, the person's got X, and then we're just going to grow it to Y, and it's going to take 40 years to do so, 30, 40 years. Now I see it because I know all these strategies, and I have a resource of expert technicians that I've built over this last 10 years. Now we can get to X to Y in 5 to 10 years, which used to take 40 years. And even the 40-year value was always vulnerable all the way through. And I'm going to wrap it on this. What's the ultimate problem or problems with traditional planning? One, it takes a lot of time. 30 to 40 years to ever get somewhere. And during that time, you can't get sick or die, or the plan dies with you. And you just are always compromising between lifestyle, and growth and protection. When you adopt these right here, you have the money, the capital, just like the government wanted back in the late 60s, to have all three at the same time: lifestyle, growth, and protection, all at once, because you're playing the way that banks and the government, which there's not much difference in between them anymore. I don't know. There's not a lot of separation, if you will. You're playing the game they want you to play. Now, all this training here, the compromising on so forth, the final point is that never reach cruising altitude. Why do planes fly at 35,000 feet? I looked it up because I was curious. They fly at 35,000 feet. Like a 747 burns like 30% of their fuel just on takeoff, just to get up to 35,000 feet. And if you look at corporate jets, they fly at 45,000 feet. And now they've got new jets that go even higher. The reason they do is because the air is thinner. They can, if there is a problem, imagine if they just took off and flew like just barely over the clouds. If there's a problem, that plane could hit the ground real quick. Well, it's easier to recover from the problem if there is one. And it uses way less fuel once it gets up to cruising altitude. Well, on this right here, this plan where your income goes up, taxes are eating you alive, plus lifestyle, plus everything else, you're going against the two biggest entities in the financial game, which is the banks and government. They want you to go with the way. And you look at like Amazon paid zero taxes in 2017 and now 2018. And the people that studied it didn't even know how they were not paying taxes. Well, they were using the three pillars. That's exactly how they did it. Now theirs is a little more advanced simply because they have more at play. They can even do stock changes and things like that. But for a normal, just a person, these three alone are what changed the game permanently. So bottom line is, this was a quick overview. I hope you got something from this. And I've put together some actual training. If you like this, you'll love training that walks you through the whole game and how to use it to your advantage. And I'm putting down here how to get to it. Right there, go there. I work with some of the wealthiest families in the country. I've studied for 10 years, not only wealthy, 100 million plus level folks, like families, as well as corporations like Amazon and multiple others, and study the difference between those that created breakaway level wealth and those that are failing. And the failure today is all about adaptation. Nobody in the government is going to give you the information I just talked to you about. So anyway, if you want to learn how to use this to your advantage and start playing at a whole different level and take whatever you have, say you're at 10 million right now. 10 million, you created it against the grain using this approach. And in fact, you might have even had some of the three pillars going on, which is awesome. I just show you how, through the training, how to do them intentionally, not by accident, and how the real math of it works. And you don't have to be a financial person to understand it. It's in layman's terms. I'm from the Midwest. I mean, yes, uh, I'm pretty good at math. However, I'm pretty simple minded, pretty common sense. So anyway, again, this is John Duncan. I hope you enjoyed it. And I will talk to you again soon. Thank you.